All right, let's be honest. Have you ever nailed a long-term trade? You're feeling like a genius, and then bam, a sudden pullback stops you out, only for you to watch in agony as it rockets hundreds of pips in your original direction. It is probably one of the most frustrating things in trading. Well, what if there was a clear, rules-based way to handle these big moves? A method that lets your trades breathe, but still keeps your capital safe. That's exactly what we're going to break down today. Welcome to AI Explains ICT. Today, we're diving deep into the core content from Month 5, Episode 18, which is all about managing those big, long-term position trades. Now, this is some pretty dense stuff with very specific, practical rules. So I'd really suggest grabbing a notebook or something to jot down some notes. You're going to want to remember this.
So here's what we've got on deck. We'll kick things off with the big challenge of long-term trading. Then we'll cover how to build your trade idea and frame the perfect entry. After that, we hit the main event, the 40-20-day management rule. And to wrap it all up, we'll walk through a live trade example so you can see it in action. Okay, let's get right to the heart of the matter. For anyone trying to hold a trade for weeks or even months, you know that getting in is the easy part. The real fight, the psychological battle, is just staying in the trade. It's about having the conviction to ride it out and actually capture that massive move you saw coming from a mile away.
I mean, does this hit close to home? You do all the homework. You wait patiently for days, maybe weeks, for that perfect setup. You finally enter the trade, and a quick, sharp little move against you takes you right out. It's just gut-wrenching. And you know why it happens? Most of the time, our stop losses are simply way too tight for the kind of moves we're trying to catch.
So that's the problem. What's the solution? Well, how do we build a trade idea that's actually strong enough to justify holding for that long? ICT gives us a 3-pillar framework to build a rock-solid directional bias. And this is all work you do before you even dream of placing an order. This is the foundation of the entire trade.
It all starts from the top down. First, you look at seasonal tendencies. You're asking, what does this market usually do this time of year? That gives you a big picture bias. Second, you need confirmation from intermarket analysis. We'll get into that. And third, you map out your big objectives on the higher timeframes. Let's dive into each of these a bit more. Okay, that second pillar, intermarket analysis, it's all about getting confirmation. The big idea here is that major market trends don't just happen in one place. It's like checking the weather forecast from multiple sources. You're looking at stocks, interest rates, commodities, and currencies to see if they're all telling you the same story. If you get at least 3 of these pointing in the same direction, you know you're not just chasing a random chart pattern. You're riding a major market-wide theme. And the third pillar is super important. You have to know where you're going. For this, we use what ICT calls the PDA, or Premium Discount Array. Don't let the name scare you. These are just the major institutional landmarks on your monthly and weekly charts. We're talking about things like big order blocks, gaps, and voids. Seriously, just think of them as powerful magnets for price. They give you a logical, predefined destination for your trade. Okay, so let's recap. You've done the high-level work, you've got the seasonal wins at your back, you've got confirmation from other markets, and you have a clear target miles away on the chart. Now, and only now, is it time to zoom into the daily chart and start hunting for our actual entry. When it's time to actually get in, you've basically got 2 choices, a stop order or a limit order. Think of it this way. A stop order chases the market and gets you in as it's moving, so you're more likely to get filled, but maybe not at the best price. A limit order is you telling the market, come to me at this specific price. It's more precise, but hey, you might miss the bus if it never pulls back. ICT says this one's really up to you and your style. Now, this next part is non-negotiable. It's absolutely crucial. For this kind of long-term position trading, you should never, ever risk more than 1% of your account on a single trade. Remember, the goal here is to catch massive moves, hundreds of pips, but we're doing it with a small, controlled risk. This is how you stay in the game long-term. All right, now we're getting to the real secret sauce of this whole thing, the core technique. This next rule is the mechanical, logical solution to the emotional problem of getting scared out of a perfectly good trade. This is how you give your position the room it needs to actually work. So this really is the million-dollar question, isn't it? How do you give a trade enough space to wiggle around and do its thing without giving back all your hard-earned profits? You need a stop that's wide enough for the noise, but you also got to lock in those gains. Well, the 40-20 rule is designed to solve this exact problem. Here's how it works. When you first get into the trade, you use the 40-day rule. Simple. If you're buying, you find the lowest low of the past 40 trading days, and you put your stop just below that. If you're selling, you find the highest high of the past 40 days and your stop goes right above it. And the logic here is just brilliant. If you're in a real, powerful trend, the market has no business going back to where it was 2 months ago. If it does, something has fundamentally changed and you probably want out anyway. This rule is designed to ignore the daily noise and only take you out if the whole trade idea is broken.
But here's the thing, you don't stick with that super wide 40-day stop forever. That's for the beginning of the trade, to help it survive the early chop. Once the trade is well into profit, let's say it's about 75% of the way to your main target, your job changes. Your priority is no longer just staying in, it's protecting what you've made. And that's when you switch to the 20-day rule. You start trailing your stop much tighter, using the last 20 days to aggressively lock in those profits as you get close to the finish line.
Look, theory is one thing, but seeing it on a real chart is where it all clicks. So let's pull up a USD/JPY example from ICT and walk through this whole process step by step. We'll see how the analysis, the entry, and the 40-20 rule all work together in the real world. Let's do it. Okay, so here we're looking at the weekly chart for the Japanese yen. First things first, we need to map out the playground. We find a major high and a major low. That's our range. And inside that range, we're looking for those PDAs we talked about. You can see a weekly bullish order block down at the bottom and a bearish one up at the top. Boom. Those are our potential destinations. Let's check out the short trade first. So you see price rallies right up into that weekly bearish order block we marked. A sell setup appears on the daily chart, we take the entry and immediately apply the 40-day rule. We look back 40 days, find the highest high, and put the stop above it. I mean, just look at how much room that gives the trade. It's way up there, far away from all the noise, keeping you safely in the position. All right, now for the flip side. Later on, price comes down into our weekly bullish order block, and we get a buy signal on the daily. We enter, and again, right away, we apply the 40-day rule. Stop goes below the lowest low of the last 40 days. Now check this out. This entry happened right around a major US election, which gave us that absolutely terrifying huge wick down. But look, because the stop was based on the 40-day rule, it was completely untouched. The trade was never even close to being stopped out. That's the power of this method. So as this long trade starts to really take off and it crosses that halfway point of the big weekly range, what we call equilibrium, that's our signal. The rules change. We ditch the 40-day look back and we switch to the tighter 20-day look back. Now, every single day, we're trailing that stop below the low of the most recent 20 days. And you can just see it on the chart, can't you? The stop starts creeping up closer and closer, locking in more and more of that profit as we approach the target. And really, this quote from ICT just says it all. You have to have some freedom in the market. You got to allow it to move a little bit. That's what this 40-20 method is all about. It's a system that gives you permission to let the market move. It forces you to manage your trade based on structure, not on fear. So it really makes you ask yourself, are you managing your trade or are your emotions managing you? Hey, if you found this video helpful and it cleared some things up for you, do us a favor and hit that like button and subscribe to the channel. And seriously, if you have any questions, drop them in the comments below. A real person will get back to you and help you out. We wish you the best. Safe trading.